Hey everybody, this is Coach D with TackleTrading.com here to talk to you about the option Greek known as gamma. Now you'll recall that the options pricing model, known as the Black-Scholes model, has quite a few variables known as the option Greeks. And those variables are the delta, the theta, the vega, gamma, and rho. And of course we're here to focus on gamma, which is also known as velocity. And what gamma is it's the rate of change of the options delta. That's why we call it velocity, because it's the rate of change. Now, gamma, this definition bears repeating. The options gamma is a measure of the rate of change of its delta. The gamma of an option reflects the change in the delta in response to a 1-point move or a $1 movement of the underlying stock price either way, up or down. Options that are deep in the money and or way out of the money, those options have low gamma, and the values get really close to zero the further in the money or out of the money those strike prices go, which means that deep in the money or out of the money options have a very low rate of change for the delta, or in other words, very low velocity. Gamma is always the highest near the money, and the gamma is absolutely going to peak with options that are 1 or 2, maybe even 3 strike prices out of the money, and they have the highest rate of gamma. So here we're looking at an options chain of the XLC, and I've got the gamma column for the Greeks highlighted on both the calls and the puts. And you can actually see next to the gamma column is the delta column, and you can actually see how the dance between delta and gamma works. Now, these are $1 strike prices. So we have a strike price of 46, which is in the money, and a strike price of 47, which is right out of the money. And you'll notice that the gamma is highest right there out of the money. Those 1, 2, 3 strike prices right out of the money have a high gamma just over 10.10. And you'll notice here that the delta of the $47 strike is 49, but it has a gamma of 10. And if it were to move $1 in the money, or again, you can see the increment between 47 and 46 is $1. Well, 49 plus 10 equals 59. That's the rate of change. So the delta changed at the rate of gamma, which was about 10 cents for every $1 it moved. So it went from 49 to 59. You can see the same thing over here with the puts, where the same thing, you look at the strike price, 46 to 47, and you look at the delta and the gamma, so that in the money option has a delta of 0.50 and it has a gamma of 10. Well, if the stock price fell $1, that gamma that was 50 would change at the rate of 10, and it would drop to about 40. So that's kind of how that works. Now here's an example of a risk graph. And on this risk graph here, this is actually a really cool demonstration of this. You can see I've got $1 increments between the current price. So the current price is $46.77. And if the stock price were to move up $1 to $47.77 or down $1 to $45.77, you can see how the delta and the gamma change. So this is an actual measurement of how much the delta would change based off of the gamma. So you can see that the current strike price, the 40, or that right there at the money, the current value of the stock is 46.77. And you look at that gamma, the delta is currently 49.16. And if it moved up $1, the delta would change to 59.59. Basically a rate of change of 10.63-ish. And if it went down $1, it would drop from 49 down about 10.63 down to 38. 0.57 and changes. So it's never perfect. It's never exactly right on, but it's a ballpark estimate of how much that delta is going to change. And so we're always looking at the gamma to understand how quickly the delta changes. And if you look at the risk graph up above, you can see how that purple line slopes, and it gets steeper as the prices run up, and that slope gets shallower as the prices run down, because that's how the gamma changes the delta. Now, remember, when it comes to the Black-Scholes model, all those variables are moving at all times. So the vega and the theta are constantly in play, and the gamma and the rho are constantly in play, and the delta and the stock price are always in play. And all those variables get pumped into that Black-Scholes model, and the option value gets spit out. You now have a much better understanding of how gamma works and how it functions inside the Black-Scholes model. And again, gamma is the rate of change of the options delta in $1 increments.